Good Thursday morning, everybody, and welcome to LeFonti International. This is the opening bell. The S&P 500 is up about 0.10%. The Dow Jones is off about 0.06%, and the Nasdaq Composite hovering around a flat line after a pretty positive trading session throughout yesterday, of course. And we have a major story when it comes to Bank of England. I'm going to report a little later today. The DXY is at a 94.22. This is, of course, all after the Fed decision to kick off with tapering later this month. Euro dollar 1.15 and sterling against the dollar at 1.3541. But I just wanted to show you what is going on with the sterling. It's off about 107%, and this is because the Bank of England held interest rates steady today, defying many investors' expectations that it will become the first major central bank to hike rates following the coronavirus pandemic. The bank's monetary policy committee voted 7-2 to keep its benchmark interest rate unchanged at its historic low of 0.1 and 6-3 in favor of continuing the existing program of UK government bond purchases at a target stock of 875 billion sterling, which is $1.2 trillion. The MPC voted unanimously to maintain its $20 billion stock of corporate bond purchases, keeping the total asset purchase program of 895 billion. So this is, of course, the Bank of England, which is certainly incredible surprise for markets. And I just wanted to bring to the show Mark Oswald, Chief Economist and Global Strategist, ADM Investor Services. Good morning, Mark, and thank you so much for joining us.
Good morning.
Of course, this is also the opening bell of the U.S., but first of all, I'd like to hear your take on Bank of England.
Well, if they could make more of a mess of communications, I think they would struggle, to be very honest. Having basically signaled a rate hike at this meeting, they've now backpedaled very strongly, and because of their backpedaling, the market's now also priced out the chance of a rate hike in December, but is still pricing in a rate hike in February. But it's really about credibility. This isn't, if you can't communicate properly with markets, and Mr. Bailey literally a couple of weeks ago was saying we will have to take action on this, then you are in a fairly deeply bad spot. And by the end of at the end of the day, it doesn't really matter what they're forecasting, when the fact of the matter is they justify not taking any action today by the fact that they are concerned about the growth outlook in the short term. They're also concerned about how the labour market will develop, and they're also basically saying that because the market's pushed rates, the rate trajectory so high, and that's what they based their inflation forecasts on, it's basically looking at inflation being below the target of 2% on the long-term time horizon of 3 years, 2.25% on the 2-year time horizon. But it doesn't really matter what they're projecting. It's this failure to communicate, and in this day and age where forward guidance is supposedly effectively the gold standard of all central bank communications, whether one likes it or not. That's not really the matter. If you are basically saying we will guide you as to what we're going to do, and then you make a complete horlicks of it as they have, then your credibility's shot. And that's at the same time as the UK government also has a little or no credibility. There is one mistake made after another. There are now questions about cronyism and its unwillingness to deal with it. It's really not a great place for the UK economy to find itself, or its political or monetary leadership.
Mark, why did it shift at the very last moment, in your opinion?
I think basically it is because the market's pushed up so hard on rates, but the market's only pushed up hard on rates because of the bank's own signalling. And I think it is by dint of the fact that they are concerned that at the end of the furlough scheme period, there were still 1 million people on it. They're not seeing, as they acknowledge, actually any increase in redundancies at the moment, but they're concerned that it may actually feed through. And they also noted the weak level of consumption demand in the UK at the current point in time, which is not really surprising given the sort of level of inflation, above all in that key non-discretionary area of food, energy, and house prices. But this is all information which was readily available 3 to 4 weeks ago, if not months ago. I mean, it was all very, very clear. So having gone through this period of signaling a rate hike and then suddenly backpedaling, even though they are still signaling they're going to hike rates, but why should we believe them? I can't see any reason at all.
I'm just looking at the sterling, which is off about 102% at 1.3547. This is, of course, against the dollar. On the other side, the euro against the sterling is up about 0.6% at 0.85. What's the outlook, in your opinion, for the sterling? And do you think that what we're seeing today is just because of this news in regards to Bank of England, which keeps interest rates steady, which was not the most likely scenario, that's for sure. And I was wondering, do you expect this performance of the sterling to continue in the following days?
Well, I think you're going to see further weakness short term. I think really what you're going to see is a lot more volatility, simply because when you start, we're going to have quite a few after the press conference tomorrow. We've got a number of the MPC members speaking again, and it'll be interesting to see how they try and communicate what exactly they intend to do with policy going forward. The fact of the matter is, I think they're likely to keep on flip-flopping, and this will lend itself to a great deal more sterling volatility in the near term. I mean, it still looks like the Bank of England, of the major central banks, is still likely to be at the front of the queue for a rate hike. But as I say, it's this lack of credibility, and that in itself lends itself to volatility. But in the short term, when they sound hawkish, markets are probably less likely to give credence to them. And that's why it was so important to actually get their communication strategy back on the straight and narrow. And in fact, if you're looking at the press conference at the moment, it's just going from bad to worse. Mr. Broadbent has said during the press conference, well, we had inflation go to 5% after the global financial crisis, and it came back down then. I don't see why there's any reason to expect anything different now. Well, we're in a very, very different situation. This is not comparable to the global financial crisis. And that doesn't actually give anyone any more confidence in the bank, in terms of the communication strategy.
I just wanted to have a very quick check also on the opening bell. Of course, this is post Fed press conference, which was also very interesting. Probably most of the viewers couldn't figure out what exactly transitory is and when, of course, the Fed is expecting to reach this full employment, which is certainly the Fed's primary target, along with price stability. The Dow is up about 0.13%, S&P 500 up about 0.13% at 4,666 points. Mark, I was wondering, what's your take on the Fed and specifically the transitority of the inflationary pressures to the upside?
Well, they are clinging to this transitory narrative, even if it was expressed in slightly weaker terms, i.e. it's likely to be transitory rather than confident that it's going to be transitory. And that wind back is obviously necessary. Nevertheless, Mr. Powell was fairly emphatic in his communication that we shouldn't see tapering, which is being done at a fairly slow pace in any case at $15 billion a month, though they have actually stressed the fact that they may actually they could pause it if things don't turn out as they expect, particularly in terms of employment and growth. But for markets, basically, it's this feeling that they're in absolutely no hurry to hike rates. They're very keen to push back on the market's rate trajectory, even though the market's repricing of the rate trajectory has only been modest, which basically also tells us quite a lot about whether the market believes the Fed's narrative about transitory inflation. And the Fed itself has acknowledged the fact that a lot of the supply chain disruptions are going to continue to create upward pressure on inflation for quite some time. I think the real message, though, is that central banks are A, fearful of removing the stimulus that they've put in place. B, they're more than well aware of the fact that actually there's not a lot they can do about either food or energy inflation. They could do quite a lot more about the pressure or upward pressure on house prices, but they don't have control, and this is really where the problem lies. Because we could easily see a spillover into wage inflation. If you looked at the wage cost index as part of the non-farm productivity data today, it came in a good deal higher than expected, over 8% on the quarter. Okay, that was something, some of that is not necessarily, it's not the best gauge of wage costs, but it is one gauge basically to say there are wage pressures there. And central banks are going to have to be extraordinarily wary, particularly given the shortage in labour supply, skilled labour supply, that is. I mean, it is particularly in that area. And particularly given the fact that we've clearly speeded up the adverse effects of aging demographics as more people leave the workforce. And therefore, this emphasis on we're not going to hike rates until we've seen full employment. Well, what is full employment if we're actually seeing a change in the structure of the labour force? It's very difficult to guess. I mean, it's an unenviable task, but placing great emphasis and basically suggesting that it's going to be the same as it was pre-pandemic, I think is rather unwise, and it pins their colours to a post, which basically may prove to be on rather shaky ground.
Yeah, this is a pretty much of an issue. Of course, we're talking about a labor shortage and talking about labor market. I just wanted to show very quickly the numbers of today's initial jobless claims: 269,000 versus 275,000, which is once again a better than expected number, and also well below the previous number, which is 283K. So once again, positive numbers. On the other side, continuing jobless claims: 2,105,000, and non-farm productivity quarter-on-quarter minus 5%. Unit labor cost quarter-on-quarter preliminary for the third quarter 8.3%, and balance of trade for September $80.5 billion. Once again, higher compared to, of course, the previous data. Mark, what's the labor market data suggesting in your opinion?
I think the labour market data is still basically telling us the same thing. There aren't as many people, that people are coming off jobless benefits, and that's a good thing and it's unsurprising given the scale of labour demand that there is. However, what we really want to know, and this is what will come out tomorrow, is what is a normal level of labour participation rate now? Is it up in the 62.5, 63 area, or is it actually below that simply because we do have an aging demographic? We have a number of people who actually are potentially could rejoin the labour force but aren't, because there are still a good deal of challenges, above all with childcare. And because in some cases they're actually fearful of going back to work. So it does create a situation which some of the metrics that the Fed uses to determine what is a solid labour market and what is a normal labour market, which I don't think we actually even know vaguely what normal labour market is, are particularly challenging. But labour demand is clearly very strong.
Thank you very much, Mark, also Chief Economist and Global Strategist, ADM Investor Services. Thank you for joining us. Have a great day ahead.
Thank you.